Valens Research, Uniform Financial Analytics.
Salesforce.com, the software company, and specifically really one of the first SaaS software companies out there. They started in terms of focusing on creating CRMs. Now they create a whole entire suite of different offerings for corporations in terms of all of the types of software offerings they need, from ERP to a CRM, et cetera. When we look at any company on a uniform accounting basis, when we look at any company on the Valens Research app, we always start on this page, the Performance and Valuation Prime page. What is this for? The reason why we call it the PVP, or Performance and Valuation Prime, is, again, because we're very literate here at Valens. We look at a company's performance in terms of its return on assets and its asset growth, right? How profitable is a business and how much can the company reinvest? And then we look at the company in terms of valuations. What is its value relative to its asset base, similar to a cleaned up price to book metric? And what is its value relative to its earnings, our cleaned up uniform accounting proprietary PE metric? And what we can see is there's two bars for each of these, right? There's an orange bar and there's a blue bar. Just focusing on the first panel here, return on assets. The orange bar is the distorted as reported return on assets for Salesforce.com, for CRM. You can see on an as reported basis, it looks like this company has never generated a return that was really above 4%. This looks like a bad business, right? This is a low return company, and if anything, its return is hovering around 0%. This does not look like a world-beating company that companies like Oracle, who have been around for 40 to 50 years, has them shaking in its boots. But when we look at the uniform accounting data, what we can see is the reality, which this company actually is incredibly powerful, right? Return on assets last year weren't 0.5%, they were 14%. And they've gotten as high historically as 35%. This is a high return business, and it makes a lot more sense when we understand how much this company has grown, right? This company hasn't grown on an as reported basis less than 15% a year. On a uniform basis, there have only been 3 years where growth has been less than 10%, because of the fact that it's so high return, right? If you saw a business that basically had no returns at all, you'd be saying, why on earth are they reinvesting so much in this business? Well, the reality is they're reinvesting so much in the business, right? Growing at 35, 60, 35, 22%, because they know they have a massively high return business, right? We are totally changing how we're thinking about this company, valuing it and understanding its performance when we look at the uniform accounting data. That changes our context. Same thing with valuations, right? Of course, because of the fact that this company has a high return, it's trading at a relatively high multiple and is growing a lot. It's trading at a relatively high multiple relative to its book assets. If you looked at the as reported metrics and saw a 5 times price to book metric, when a company has a 0% return, you'd be saying, what on earth is going on here? This is a screaming short. We say this is a massively high growth business with ROAs that are impressively high, even if they've declined recently. Of course, it's trading at a high premium. Same thing for PE. On an as reported basis, you're thinking, why on earth is this company trading at a 70 times PE when it has no return? It's throwing money into a low return business. Well, we see uniform accounting metrics that show it's a 60 times multiple, but for a high return, high growth business, it makes sense all of a sudden. And the last chart that we have here is TSR-R. What does that mean? The first 3 letters, TSR, means total shareholder return. Total shareholder return is what is the total return that you as an investor would have gotten owning the stock in terms of both capital appreciation, the stock rising, and any dividend income you would have gotten for the name. Obviously, for Salesforce, historically, that's been basically 0. The last R, the tiny r, is relative. Relative to what? Relative to the market. Since Salesforce is a US listed name, that means relative to the S&P 500, which is what we use as its benchmark. When this line is flat here, that means that Salesforce performed in line with the S&P 500. When it's up, that means Salesforce underperformed the market. When it's down, that means when it's up, that means Salesforce outperformed the market. When it's down, that means Salesforce underperformed the market. What we can see here is there's a powerful relationship that you don't see with as reported metrics when you look at the uniform accounting metrics. You can see with returns that were improving and high growth, TSR was outperforming the market. When returns were basically flat to down, but the company was still reinvesting, it was basically sideways relative to the market. And then recently, when returns started to ramp, right? When returns started to ramp, TSR took off, and now returns are coming down because it's reinvesting. So earnings actually have been relatively flat. TSR is flat. It makes a lot more sense, which it never does when we look at the as reported metrics. It makes a lot more sense looking at the uniform accounting metrics. Then what's really powerful, though, is not just understanding a company's profitability historically and its growth profitability. If you want to buy a name, right, we start with that, but then we want to understand what is the market pricing in, and does the market already know how good a company is? And that's when these last 5 bars here and here become so powerful, because it is the literally secret weapon we have here at Balance using our proprietary uniform accounting framework to understand what the market is pricing in and if a company really does look cheap or not. These 2 light blue bars here are what sell-side Wall Street analysts are forecasting Salesforce to do in terms of return on assets the next 2 years when we push their estimates through our uniform accounting framework. This bar here is what they expect asset growth to be, how much they expect the company to reinvest in the business. These white bars are what the market is pricing Salesforce to do at a $250 billion market cap and a $250 stock price. So if Salesforce doesn't grow at 12% a year and see returns reach all-time highs, well, this company looks overvalued. So the question is, do we think that both those things are reasonable? And the first thing that would jump out to us, and we can use our embedded expectation tool right here to actually do some scenario analysis, is in reality, this company's growth has been north of 25% a year the last 10 years. Well, that's really 25 years, honestly. So let's say that we actually think that the market understands that this company is going to grow a lot more than 10% a year. If we think this company is going to grow at 25% a year, to be fairly valued, return on assets just needs to get to 20%, 20 to 25%. That's in the middle of where the range has been from 14 to 35% the last couple of years. And right, if the company slows down its rate of investment from 35 to 65%, which is what's been pulling down returns the last couple of years, slows it down to these kind of 25% levels where returns have historically been level or even improving, that's not outlandish, right? So what we can look at here is we can say, hey, you know what? Market expectations for Salesforce are not unreasonable. That makes Salesforce look a lot more interesting. But we can only understand what's going on here because of the fact that uniform accounting shows us what Salesforce real returns are and real growth is. On top of that, let's just say that we do think the company is going to grow at 25% a year, but we don't just want to understand what the market's pricing in right now. We want to understand what we think the company is worth if we think returns can reach back to all-time peaks. What we can do is we can quickly use the embedded expectation tool here to put in our scenario for asset growth and ROA and solve for stock price. And what do we see? A company's net stock price would actually be 50% higher if we thought this could happen. Again, though, we wouldn't even know to have this conversation to say, could returns improve to, 6 times cost of capital to 3 times what corporate average profitability is if we were looking at as reported metrics, because we would think this is a terrible business that's never made a profit. And we would think that we were betting on hopes and prayers, not just betting on the company getting back to what it's done historically. This is the kind of context that we totally miss when we use as reported metrics.
Valuations Research, the world's leading source for uniform financial analytics.